Hello, everyone. Welcome to Chapter 16, How to Read, Analyze, and Interpret Financial Reports. When you think about financial reports, whether it is the balance sheet or the income statement, go back. These are reports prepared by companies that tell us certain information about that business organization. We'll first look at what's known as a balance sheet and discuss the components of the balance sheet. And we'll then look at a statement known as an income statement and discuss the components of the income statement. And last, we have what we call trend and ratio analysis. So you ready? Let's go. First, we have what's known as the accounting equation. This equation says assets equal liabilities plus owner's equity. Assets refers to things of value that are owned or controlled by a business organization. Liabilities, that's the word I'm trying to say, refer to the existing debts or obligations of a business. So when a company owes another company because they receive product or services on account, meaning on credit, they have what's known as liabilities. So if you have credit card debt, a mortgage, car note, student loans, then you have examples of what's known as liabilities. Then we have owner's equity. Owner's equity shows the owner's financial interest into his or her business organization. So in essence, we look at all of the assets of the business. If we subtract out the liabilities, what's remaining is known as owner's equity, which shows the owner's financial interest into his or her business organization. So we have a statement that is known as a balance sheet. The balance sheet shows a company's net worth, its value, as of a particular date. The balance sheet shows all of the assets of the business, the things of value. It also shows who owns those assets, meaning the liabilities as well as the owner's equity of the business. So the balance sheet, just like the accounting equation, must always be in balance, meaning the assets, the amount the company owns, equal liabilities plus owner's equity. So liability shows the creditor's claim against the assets. Owner's equity shows the owner's claim against the actual assets. So if we had assets for 10,000, perhaps 4,000 is owed to our creditors. The remaining 6,000 came from the actual owner. So you'll see that the balance sheet must always balance. Assets must equal our liabilities plus owner's equity. So here we have a sample of what's known as a balance sheet. Try to make this a little better for you. There we go. So the balance sheet is broken down between assets, liabilities, and owner's equity. Okay. For the asset category, we have what's known as current assets and what's called plant and equipment assets. When you think about current assets, these are assets that we're going to convert into cash or we're going to use up in a time period of less than 1 year from your balance sheet date. Again, current assets refer to asset accounts that we can convert into cash or will be used in a time period of less than 1 year from your balance sheet date. When you have your plant and equipment assets, these are referred to as being long-term assets. Assets being used by the company for operational purposes in order to earn revenue income for the business organization. So for this illustration, we have total current assets, total for our plant equipment assets, total assets total $205,000. On the other side, you have what's known as your liabilities. These are the existing debts or obligations of a business, or referred to as being liabilities, broken down between current liabilities and what's known as long-term liability. Whether current or long-term depends upon when does the debt become due. So if the item must be paid within 1 year from your balance sheet date, we record that as a current liability. If the debt becomes due in a time period longer than 1 year from the balance sheet date, that is known as a long-term liability. So we have total current liabilities, total long-term, add those together to get total liabilities of $150,000. Then the next section is known as the stockholders' equity section. When you think about the corporate structure of a business, these stockholders are the owners of that business organization. So when the Mool Company sells stocks to the stockholder, it goes to an account known as common stock. So common stock shows the cash received from selling shares of stock to the stockholders of the actual company. Then we have a section known as retained earnings. The word retained means to keep. What are you keeping? Your earnings. So this shows the portion of the profit earned by the company that was not paid to their stockholders in the form of what's known as dividends. So if we made $10,000, but we paid out $3,000 to our stockholders, then $7,000 goes to our retained earnings account. Again, it shows that portion of the company's profit that's been kept inside of the business organization. When you add together those different sections of stockholders' equity, they total $55,000. Now remember that the balance sheet must always be in balance. The total of your assets must equal total liabilities plus your stockholders' equity. Both sides total $205,000. So the balance sheet is prepared as part of what's called the annual report by a company. It shows their total assets on a specific date, their total liabilities, and the stockholders' equity amount as of a particular date, that date being December 31st of 2019. Okay. Now, with the actual balance sheet, we can put it in different formats. We have what's called the vertical analysis of a balance sheet, where we're going to divide each asset as a percentage of the total assets. And for the liabilities and stockholders' equity, the same thing. We're going to show each line item as a percentage of the total liabilities and stockholders' equity. So we would say cash represent what portion of our total assets? Accounts payable represent what portion of our liabilities and stockholders' equity? So let's take a look at what's called the vertical analysis of a balance sheet. So what you see up top would be all of your asset accounts. This is 2019 and 2018. We like to compare data from one accounting period to the next to see whether we're improving, if things got worse, or what's the situation going on with our company. So here you have the 2018 numbers on the balance sheet, the assets, and it shows their percentage. So in 2018, cash represents 22.2% of our total assets, where in 2019, it increased to 25.88% of our current assets. So what is shown, each line item for each year is shown as a percentage of that company's total assets. Okay? Note that the total percentage must equal 100% when you add the percent together of all the different assets. But with the vertical analysis, we're going to show each line item on the balance sheet as a percentage. So for the assets, each one is shown as a percent of the total assets of the business organization. We'll do the same thing for our liabilities. We're going to show each line item as a percentage of our total liabilities, stockholders' equity. So for comparison purposes, in 2018, the total liabilities represented 55.56% of the total liabilities of stockholders' equity. That number decreased down to 52% roughly in 2019. So we can see that from 18 to 19, our debt decreased slightly, and now our equity is a higher percentage than it was in the previous year. And that's good. It means that we're relying less upon debt in 2019, and now more of the assets are coming from the owners and the stockholders' equity section. From a horizontal analysis of a balance sheet, we'll now look at information, go back, from a increase or a decrease portion, meaning we're going to choose a base. That base may be cash. And we're going to compare everything according to that base to see whether an item has increased or decreased. Let's get right to it. So for example, if I take a look at my 2019-2018 balance sheet, and now we're looking at our cash. We're comparing cash from 2018 to 2019. We can see that cash increased by $2,000. Using 2018 as our base of $4,000, that means cash increased by 50% from 2018 to 2019. Account receivable was $6,000 in 2018, $5,000 in 2019. Therefore, it decreased by $1,000. Again, using $6,000 as the base, the account receivable decreased by 16.67% from 2018 to 2019. So the numbers from the older year will be used as the base. Notice that for our plant equipment assets, there wasn't any change. So all the change came from our current assets. The inventory account we see had the biggest change. It was $4,000 in 2018, increased to $9,000 in 2019, an increase of $5,000. But as a percentage, the inventory account increased by 125%. Because if you take the 4,000, which is your base. So if I take the 5,000 increase, divide that by 4,000, that'll give me 1.25 as a decimal, which is 125%. Okay? So we've covered in detail this first statement known as a balance sheet. We're going to come back with a second video and look at a statement known as an income statement.